Hey there, welcome to Sumit Academy. I do hope that you're benefiting from my videos. Do subscribe to my channel so that you do not miss out on my previous or future videos. This is the fifth edition of the series on current affairs, news you can use. In this video, we shall cover the news about India's forex reserves crossing $500 billion and what it means for the economy. Forex reserves are external assets in the form of gold, SDRs, that is special drawing rights of the International Monetary Fund, and foreign currency assets, that is capital inflows to the capital markets, foreign direct investment, and external commercial borrowings. They are all known as foreign currency assets. Now these have been accumulated by India and are controlled by the Reserve Bank of India. India's foreign exchange reserves have surged by a massive 8.22 billion US dollars in the week ended June 5th, and this is according to the data from the Reserve Bank of India. Expressed in dollar terms, the foreign currency assets include the effect of appreciation or depreciation of non-US units like the euro, pound, and yen, which are held in the foreign exchange reserves. Unlike in 1991, when India had to pledge its gold reserves to stave off a major financial crisis, the country can now depend on its soaring foreign exchange reserves to tackle any crisis on the economic front. While the situation is gloomy on the economic front, with GDP set to contract for the first time in 40 years, and manufacturing activity and trade at a standstill, this is one data point that India can cheer about amidst the COVID-19 pandemic. Now, while our forex reserves jumped by $8.2 billion in the week ended June 5, 2020, since the announcement of lockdown in March, it has surged by $31.8 billion. Hitting an all-time high of $501.7 billion as on June 5, 2020, India has come a long way since its forex reserves of $5.8 billion as of March 91. The surge in India's foreign exchange reserves means that while during any financial crisis, India had to pledge its gold reserves to tide over the crisis, now the country can depend on its forex reserves. So why are forex reserves rising despite the slowdown in the economy? The major reason for the rise in forex reserves is the rise in investment by foreign portfolio investors in Indian stocks and foreign direct investments or FDIs. Foreign investors had acquired stakes in several Indian companies in the last 2 months. According to the data released by RBI, while the FDI inflow stood at $4 billion in March, it amounted to $2.1 billion in April. Forex inflows are set to rise further and cross the $500 billion mark as Reliance Industries subsidiary Jio Platforms has witnessed a series of foreign investments totaling rupees 97,000 crores. On the other hand, the fall in crude oil prices has brought down the oil import bill, saving precious foreign exchange. Similarly, overseas remittances and foreign travels have fallen steeply, down 61% in April from $12.87 billion earlier. The months of May and June are expected to show further decline in dollar outflows. So, what is the significance of rising forex reserves? The rising forex reserves give a lot of comfort to the government and the Reserve Bank of India in managing India's external and internal financial issues. Now, this is at a time when the economic growth is set to contract by 1.5% in 2020-21. It is a big cushion in the event of any crisis on the economic front and enough to cover the import bill of the country for a year. The rising reserves have also helped the rupee to strengthen against the dollar. The foreign exchange reserves to GDP ratio is around 15%. Reserves will provide a high level of confidence to markets that the country can meet its external obligations, demonstrate the backing of domestic currency by external assets, assist the government in meeting its foreign exchange needs and external debt obligations, and maintain a reserve for national disasters or emergencies. Have you ever wondered what the RBI does with the forex reserves? The Reserve Bank functions as the custodian and manager of the forex reserves and allocates the dollars for specific purposes. For example, under the liberalized remittances scheme, individuals are allowed to remit up to $250,000 every year. The RBI uses its forex kitty for the orderly movement of the rupee. It sells the dollar when the rupee weakens and buys the dollar when the rupee strengthens. Of late, the RBI has been buying dollars from the market to shore up the forex reserves. When the RBI mops up dollars, it releases an equal quantity in rupees. Now, this excess liquidity is sterilized through issue of bonds and securities and liquidity adjustment facility or LAF operations. A new term, so let us study what this now means. What is liquidity adjustment facility? A liquid adjustment facility, LAF, is a tool used in monetary policy primarily by the Reserve Bank of India that allows banks to borrow money through repurchase agreements. They are called repos, or for banks to make loans to the RBI through reverse repo agreements. This arrangement manages liquidity pressures and assures basic stability in the financial markets. Liquidity adjustment facilities are used to aid banks in resolving any short-term cash shortages during periods of economic instability or from any other form of stress caused by forces beyond their control. Various banks use eligible securities as collateral through a repo agreement and use the funds to alleviate their short-term requirements, thus remaining stable. The facilities are implemented on a day-to-day basis as banks and other financial institutions ensure they have enough capital in the overnight market. The transacting of liquidity adjustment facilities takes place via an auction at a set time of the day. An entity wishing to raise capital to fulfill a shortfall engages in repo agreements, while one with excess capital does the opposite, that is, executes a reverse repo. And where are India's forex reserves kept? A relevant question, isn't it? The RBI Act 1934 provides the overarching legal framework for deployment of reserves in different foreign currency assets and gold within the broad parameters of currencies, instruments, issuers, and counterparties. Now, as much as 64% of the foreign currency reserves are held in securities like treasury bills of foreign countries, mainly the United States. 28% is deposited in foreign central banks, and 7.4% is also deposited in commercial banks abroad. Now, this is all as per the data released by the Reserve Bank of India. India also held 653.01 tons of gold as of March 2020, with 360.71 tons being held overseas in safe custody with the Bank of England and the Bank for International Settlements, while the remaining gold is held domestically. Well, that's all from me in this 5th edition of Current Affairs News You Can Use. I acknowledge with gratitude the news reports in various media publications on the subject. Do keep a lookout for further editions in this series of News You Can Use. I hope you liked this video. Do share it on your Facebook page and do subscribe to my channel so that you don't miss out on my previous or future videos. Till later then, cheerio.